International Monetary System. This chapter explores factors that determine exchange rates and various international attempts that manage them. It also presents different methods of forecasting exchange rates and the functioning of the international monetary system. The objectives of this chapter are to explain how exchange rate influence the activities of domestic and international companies, identify the factors that help determine exchange rate and their impact on business, describe the primary methods of forecasting exchange rates, and discuss the evolution of the current international monetary system and explain how it operates. How exchange rates influence business activities. Exchange rates affect demand for products. When a country's currency is weak, the price of its export declines, making the exports more appealing on world markets. The devaluation is the intentional lowering of the value of a currency by the nation's government. It gives domestic producers an edge on world markets, but also reduces citizens' buying power. The revaluation is the intentional raising of the value of a nation's currency. It increases the price of exports and reduces the price of imports. Exchange rates affect profits earned abroad when repatriated by the parent company into the home currency. Translating subsidiary earnings from a weak host country currency into a strong home currency reduces earnings and vice versa. Desire for stability and predictability. Stability makes for accurate financial planning and cash flow forecast. Predictability reduces odds that a company will be caught off guard by unexpected rate changes. It reduces the need for costly insurance, currency hedging, against possible adverse exchange rates. This figure reveals periods of stability and instability of the US dollar over time. Buying power example. Stable exchange rates do not guarantee a currency's buying power because purchasing power fluctuates. Suppose the same dinner costs you $60 in New York, $80 in Japan, and $30 in Mexico. This means that your dollars lost purchasing power in Japan and gained purchasing power in Mexico. What are the key differences between the concepts of devaluation and revaluation? Devaluation is the intentional lowering of the value of a currency by the nation's government. It lowers the price of a country's exports and increases the price of imports because the country's currency is now worth less on world markets. But devaluation also reduces a currency's buying power. Revaluation is the intentional raising of the value of a currency by the nation's government. It increases the price of a country's exports and lowers the price of imports. Revaluation boosts the currency's buying power. What factors determine exchange rates? To understand what determines exchange rates, it's important to know the law of one price and the purchasing power parity. Each tells the level at which an exchange rate should be. The law of one price. The law of one price says that an identical product must have an identical price in all countries when expressed in the same currency. Product must be identical in quality or content and be entirely produced within each country. If prices were not identical in each country, an arbitrage opportunity would arise. Traders would buy in the low-priced market and sell in the high-priced market. Buying drives up the price in one market and drives down the price in the other. The Economist magazine publishes its Big Mac Index using the law of one price to determine the exchange rate between the US dollar and other currencies. This index is a fair predictor of the direction rates should move. Purchasing power parity. Purchasing power parity is the relative ability of two countries' currency to buy the same basket of goods in those two countries. It tells how much of currency A A person in nation A needs to buy the same amount of products that someone in nation B can buy with currency B. It considers price levels in adjusting the relative value of the two currencies. Economic forces will push a market exchange rate toward that calculated by PPP, or an arbitrage opportunity arises. Purchasing power parity holds for internationally traded products that are not restricted by trade barriers and entailing few or no transportation costs. Role of inflation. Inflation erodes purchasing power. If money is injected into an economy that is not producing greater output, a greater amount of money is spent on a static amount of products. Demand soon outstrips supply and prices rise. Inflation key factors. Impact of money supply decisions. Governments manage the supply of and demand for currency with policies that influence the money supply. Monetary policy refers to activities that directly affect a nation's interest rates or money supply. Governments buy or sell government securities on the open market to influence the money supply. Fiscal policy involves using taxes and government spending to influence the money supply indirectly. Governments can increase or lower taxes, or increase or decrease government spending. Impact of unemployment and interest rates. Threat of a company moving abroad for lower wages holds down wages at home. Companies then need not raise prices to pay higher wages, lowering inflationary pressures. Low unemployment puts upward pressure on wages. To maintain profit margins with higher labor costs, producers pass the cost of higher wages on to consumers in higher prices, causing inflationary pressure. Low interest rates encourage consumers and businesses to borrow and spend, causing inflationary pressure. How exchange rates adjust to inflation. Exchange rates adjust to different rates of inflation across countries, which is necessary to maintain purchasing power parity between nations. For example, if inflation in Mexico is higher than the United States, the exchange rates adjust to reflect that a dollar will buy more pesos due to higher inflation in Mexico. U.S. goods become more expensive for Mexican firms, and Mexican goods become cheaper for U.S. companies. Role of interest rates. The interest rate a bank quotes a borrower is the nominal interest rate. Let's talk about the Fisher effect. The Fisher effect is the principle that the nominal interest rate is the sum of the real interest rate, the expected rate of inflation over a specific period. The real rate of interest should be the same in all countries because of arbitrage. The international Fisher effect is the principle that a difference in nominal interest rates supported by two countries' currencies will cause an equal but opposite change in their spot exchange rates. Because real interest rates are theoretically equal across countries, any difference in interest rates in two countries is due to inflation. Evaluating purchasing power parity. Purchasing power parity is better at predicting long-term exchange rates than short-term rates. Short-term forecasts, however, are most beneficial to managers. Impact of added cost. PPP assumes no transportation cost, and thus overstates the threat of arbitrage. The presence of transport costs can allow unequal prices between markets to persist, causing PPP to fail. Impact of trade barriers. PPP assumes no trade barriers, but a high tariff or outright ban on a product can impair price leveling, causing PPP to fail to predict exchange rate accurately. Impact of business confidence and psychology. Purchasing power parity overlooks business confidence and human psychology. Yet nations try to maintain confidence of investors, business people, and consumers in their economies and currencies. Which of the following principles can be interpreted as the exchange rate between two nations' currencies that is equal to the ratio of their price levels? The correct answer is C. Purchasing power parity. The principle known as the purchasing power parity can be interpreted as the exchange rate between two nations' currencies that is equal to the ratio of their price levels. Before undertaking any international business activity, managers should estimate future exchange rates and consider the impact of currency values on earnings. 2 market views. Efficient market view. In an efficient market, prices of financial instruments quickly reflect new public information made available to traders. The efficient market view says that prices of financial instruments reflect all publicly available information at any given time. Forward exchange rates are accurate forecasts of future rates and reflect market expectation about the future value of two currencies. Forward exchange rates are the best possible predictors of exchange rates and worthless to seek out information that may affect future rates. Inefficient market view. The inefficient market view says that prices of financial instruments do not reflect all publicly available information. Proponents believe that companies can search for information to improve forecasting. This view is more compelling considering private information. For example, if a currency trader holds privileged information, the trader can act on this information to make a profit. Forecasting techniques. Fundamental analysis. Fundamental analysis employs statistical models based on fundamental economic indicators to forecast exchange rates. Economic variables in these models include inflation, interest rates, the money supply, tax rates, government spending, the nation's balance of payments situation, and government intervention in foreign exchange markets. Technical analysis. Technical analysis employs past trends in currency prices and other factors to forecast exchange rates. Using statistical models and past data trends, analysts estimate the conditions prevailing during changes in exchange rates and estimate the timing, magnitude, and direction of future changes. Difficulties of forecasting. Beyond problems with data used, failing can be traced to human error. For example, people might miscalculate the importance of certain economic events, placing too much emphasis on some elements and ignoring others. Adjusting to currency swings. Companies facing a strong or rising home country currency may wish to prune operations to cut costs and boost efficiency. Adapt products to better suit international customers. Source abroad for inputs if this reduces cost. Freeze prices to keep sales moving. Company facing a weak or falling home country currency may wish to source domestically to shorten the supply chain and avoid an exchange rate risk. Grow at home against the higher priced imports of competitors. Push exports to exploit the price advantage gained from a weak currency. And reduce expenses by using the latest communication and transport technologies. Evolution of the international monetary system. Early years, the gold standard. Gold was internationally accepted for paying for goods and services. Its limited supply caused high demand and it can be traded, stored, and melted into coins or bars, making a good medium of exchange. But its weight made transport expensive, and if a ship sank, the gold was lost. Gold standard was an international monetary system in which nations linked the value of their paper currencies to a specific value of gold. The gold standard operated from the early 1700s until 1939. The gold standard offered several advantages. First, it reduced the risk in exchange rates because it locked exchange rates between currencies. Fixed exchange rates reduced the risk and cost of trade, and in turn helped expand world trade. Second, the gold standard imposed strict monetary policies that required nations to convert paper currency into gold if demanded by holders of the currency. This forced nations to keep adequate gold reserves on hand. A nation could not let paper currency grow faster than the value of its gold reserves, which controlled inflation. Third, the system helped correct a nation's trade imbalance. If a nation imports more than it exports, gold flowed out to pay for imports. The government must decrease the supply of paper currency in the domestic economy because it could not have paper currency in excess of gold reserves. As the money supply falls, so do prices of goods and services because fewer dollars are chasing the same supply of goods and services. Falling prices make its export cheaper on world markets, and exports rise until the nation's international trade is in balance. In the case of a trade surplus, the inflow of gold supports an increase in the supply of paper currency. This increases the demand for and cost of goods and services. Exports fall in reaction to their higher prices until trade is in balance. Collapse of the gold standard. Gold standard was violated when nations in the First World War financed the war by printing paper currency. This caused rapid inflation and caused nations to abandon the gold standard. Britain returned to the gold standard in the early 1930s at the same par value that existed before the war. The United States returned to the gold standard at a new, lower par value that reflected the inflation of previous years. The US decision in 1934 to devalue its currency and Britain's decision not to do so lowered the price of US exports and increased the price of British goods imported. Countries retaliated against one another through competitive devaluations to improve their own trade balances. Faith in the gold standard vanished as it was no longer an accurate indicator of a currency's true value. Bretton Woods Agreement. The Bretton Woods Agreement is a 1944 accord among nations to create a new international monetary system based on the value of the US dollar. It is designed to balance strict discipline of the gold standard with flexibility to manage temporary domestic monetary difficulties. It had four main features. First, it fixed exchange rates. The agreement incorporated fixed exchange rate by tying the value of the US dollar directly to gold and the value of other currencies to the value of the dollar. It fixed US dollar par value at $35 per ounce of gold, and other currencies had par values against the US dollar instead of gold. Members were to keep their currencies from deviating more than 1% above or below their par values. It also extended the right to exchange gold for dollars only to national governments. Second, it built flexibility into the system. The agreement allowed devaluation only in extreme circumstances called fundamental disequilibrium, which is when a trade deficit causes a permanent negative shift in the balance of payments. Devaluation in such situations was to reflect a permanent economic change in a country, not temporary misalignments. Third, it created the World Bank to fund national economic development. World Bank's immediate purpose was to finance European reconstruction after the Second World War. It later shifted its focus to the general financial needs of developing countries. World Bank finances economic development projects in Africa, South America, and Southeast Asia and offers funds to countries unable to obtain capital for projects considered too risky. It often undertakes projects to develop transportation networks, power facilities, and agricultural and educational programs. Fourth, it created the International Monetary Fund. IMF was created to regulate fixed exchange rates and enforce the rules of the international monetary system. Purposes of the IMF are to promote international monetary cooperation, facilitate expansion and balance growth of international trade, promote exchange stability with orderly exchange arrangements, and avoid competitive exchange devaluation, make resources temporarily available to members, shorten the duration and lessen the degree of disequilibrium in the international balance of payments of member nations. Collapse of the Bretton Woods Agreement. Bretton Woods faltered in the 1960s because of U.S. trade and budget deficits. Nations holding U.S. dollars doubted that the U.S. government had gold reserves to redeem all its currencies held outside the United States. Demand for gold in exchange for dollars caused a large global sell-off of dollars. In fact, in 1971, the U.S. government held less than one-fourth of the amount of gold needed to redeem all U.S. dollars in circulation. The Smithsonian Agreement was to restructure and strengthen the international monetary system. It lowered the value of the dollar in terms of gold to $38 per ounce of gold. It required that other countries increase the value of their currencies against the dollar, and increased the 1% flotation band to 2.25%. Final days. Many nations abandoned the system in 1972 and 1973, and currency values floated freely against the dollar. Now, before moving further, recall what you've just heard and try to answer this question. What characteristics of the gold standard lead some to call for its return today? The gold standard linked nations' paper currencies to specific values of gold and indirectly to one another. First, fixed exchange rates between currencies reduced exchange rate risk. Second, it imposed monetary policies on nations by forcing them to convert their paper currencies into gold upon demand by holders of the currency. This tightly controlled inflation because nations could not let their paper currency grow faster than the value of their gold reserves. And third, the system helped correct trade imbalances because a nation experiencing a trade deficit would need to decrease its domestic supply of paper currency, which would lower domestic prices, which would lower prices for the nation's exports, which would increase exports until trade was once again balanced. A managed float system emerges. The new system of floating exchange rates was to be a temporary solution. Instead of the emergence of a new international monetary system, there emerged several efforts to manage exchange rates. The Jamaica Agreement is an IMF accord in 1976 that formalized the present system of floating exchange rates. Three main provisions included the endorsement of a managed float system of exchange rates, the elimination of gold as the primary reserve asset of the IMF, and the expansion of the IMF to act as a lender of last resort for nations with balance of payments difficulties. Later accords. Between 1980 and 1985, the US dollar rose against other currencies, pushing up prices of US exports and adding to a US trade deficit. The Plaza Accord in 1985 was an agreement among the largest industrialized economies known as the G5, Britain, France, Germany, Japan, and the United States, to act together in forcing down the value of the US dollar. The Louvre Accord in 1987 was an agreement among the G7 nations, the G5 plus Italy and Canada, that affirmed the dollar was appropriately valued and that they would intervene in currency markets to maintain its current market value. Today's exchange rate arrangements. Today, the international monetary system remains a managed float system, but some nations maintain more stable exchange rates by tying their currencies to other currencies. Pegged exchange rate arrangement. The pegged exchange rate arrangements peg a country's currency to a more stable and widely used currency in international trade. Many small countries peg their currencies to the dollar, euro, the special drawing right of the IMF, or other individual currency. Others peg their currency to baskets of currencies. The currency board. A currency board is a monetary regime based on a commitment to exchange domestic currency for a specified foreign currency at a fixed exchange rate. The government is legally bound to hold an amount of foreign currency equal to the amount of domestic currency. This helps cap inflation. The currency board's survival depends on sound budget policies. European monetary system. Europe looked for a system that could stabilize currencies and reduce exchange rate risk. In 1979, they created the European Monetary System (EMS) to stabilize exchange rates. It was ended in 1999 when the European Union adopted a single currency. How the system worked. The exchange rate mechanism (ERM) limited fluctuations of European Union member currencies within a trading range or target zone. The EMS was successful. Currency realignments were infrequent and inflation was controlled. Problems arose in 1992 and the EMS was revised in 1993 to allow currencies to fluctuate in a wider band from the midpoint of the target zone. The exchange rate mechanism, too, was introduced in 1999 to link the euro to the currencies of nations applying for membership in the European Union. Recent financial crisis. Despite nations' best efforts to head off financial crises within the international monetary system, the world has seen several wrenching crises. Developing nations' debt crisis. By the early 1980s, developing countries, especially in Latin America, had amassed huge debts payable to large international commercial banks, the IMF, and the World Bank. To prevent a meltdown of the entire financial system, international agencies revised repayment schedules. In 1989, the Brady Plan called for large-scale reduction of poor nations' debt, exchange of high-interest loans for low-interest loans, and debt instruments tradable on world financial markets. Mexico's peso crisis. Rebellion and political assassination shook investors' faith in Mexico's financial system in 1994. Mexico's government responded slowly to the flight of portfolio investment capital. In the late 1994, the Mexican peso was devalued, forcing a large loss of purchasing power on ordinary Mexican people. The IMF and private commercial banks in the United States provided about $50 billion in loans to shore up Mexico's economy. Mexico repaid the loans ahead of schedule and once again has a sizable reserve of foreign exchange. Southeast Asia's currency crisis. On July 11, 1997, the speculators sold off Thailand's baht on world currency markets. The baht plunged and every other economy in the region was in a slump. The shockwaves of Asia's crisis could be felt throughout the global economy. Indonesia, South Korea, and Thailand needed IMF and World Bank funding. As incentives to begin economic restructuring, IMF loan packages came with strings attached. The crisis was likely caused by a combination of, first, the Asian-style capitalism, lax regulation, loans to friends and relatives, lack of financial transparency. Second, the currency speculators and panicking investors. And third, persistent current account deficits. Russia's ruble crisis. Russia's problems in the 1990s included the spillover from the Southeast Asia crisis, the depressed oil prices, falling hard currency reserves, an unworkable tax system, and inflation. In 1996, as currency traders dumped the ruble, the Russian government attempted to defend the ruble on currency markets. The government received a $10 billion aid package from the IMF and promised to reduce debt, collect taxes, cease printing sums of currency, and peg its currency to the dollar. Things improved for a while, but then in mid-1998, the government found itself once again trying to defend the ruble. By late 1998, the IMF had lent Russia more than $22 billion. Argentina's peso crisis. By late 2001, Argentina had been in recession for nearly 4 years. Argentina's goods remained expensive because its currency was linked to a strong US dollar through a currency board. The country finally defaulted on its $155 billion of public debt in early 2002, the largest default by any country ever. The government scrapped its currency board that linked the peso to the US dollar, and the peso quickly lost about 70% of its value on currency markets. Argentina has in many respects recovered. It has registered growth of around 9% a year and unemployment around 8% in 2008, down from a high of 20% in 2002. Argentina's plan of boosting wages, imposing price controls, keeping the peso low, and increasing public spending seems to be working. Growth was expected to be around 4% to 5%, but inflation was at 9% a year and reducing purchasing power. As of 2010, another economic collapse was unlikely, although Argentina was experiencing 10% and more inflation. Europe debt. More recently, some nations in the European Union had let their debt soar to unsustainable levels. In 2010, the IMF and European Union organized a bailout for Greece, but the Greek people reacted with anger and protest to the austerity measures forced upon them. By mid-2011, Portugal had also received a bailout, and Ireland and Spain looked as though they may be next. This financial crisis underscored the need for managers to fully understand the complexities of the international financial system. Future of the international monetary system. Recurring crises are raising calls for a new system designed to meet the challenges of a global economy. The revision of the IMF and its policy prescriptions are likely. Transparency on the part of the IMF is being increased to instill greater accountability. The IMF is increasing its surveillance of members' macroeconomic policies and abilities in the area of financial sector analysis. Ways must be found to integrate international financial markets to manage risk. The private sector must become involved in the prevention and resolution of financial crises. Recent financial crises underscored the need for managers to fully understand the complexities of the international financial system. Chapters 9 and 10 discuss the international financial markets and international monetary system. Understanding this material improves managers' knowledge of financial risk in international business. But this knowledge must be paired with vigilance in financial market conditions to manage businesses in the global economy effectively.